Hey guys, it's Sasha. As we're entering the new year, I wanted to share my 10 ninja tips for making the most of your investing strategy in 2022. These are tips that I am using myself in my own investing portfolio, and I think these can help you a lot with figuring out the stock market for beginners or seasoned investors. I am going to start with a strategy that is likely to apply at the beginning of the year, and that is going heavy on the big dip. In December 2021, the stock market put a whole lot of growth stocks on massive discounts as inflation fears, interest rates, and Omicron, and all of that caused a lot of panic. And a lot of these growth stocks are still trading at 50% or even 60% and lower than their prices before this dip happened. If you thought that some of these were great investments before the prices dropped, then now you are able to go and pick up these stocks at a massive discount and double whatever return you would have made before. And that is a relatively rare opportunity. And some of these stocks are growing at rates of 50 to 70% per year and now trading at actually reasonably modest multiples, even by the standards of people who don't invest in growth stocks. Just remember to do your own research, proper due diligence, and proper analysis, because not all growth stocks are the same. And remember that I am just a random guy on the internet, and I am not your financial advisor, much like any other random guy on YouTube you might watch. So while this dip is a great opportunity to load up on some stocks and make particularly big returns as a result in the long term, don't go buying everything with a sales sticker, especially if a salesperson tells you to do so. And the second tip is to prepare for some bad inflationary pain, because the latest inflation figures for November 2021, as I'm recording this video, are 6.8% on all items in the US, which probably means that the real terms inflation, including actual movements in rent, etc., is in the double digits. The Federal Reserve is still deliberating very slowly on what to do, and they are really dragging their feet. A recent announcement has increased the forecast on rate rises by the Fed, but these forecasts are still incredibly low. We went from 1 increase to 0.3 to 3 increase to 0.9% through the whole of 2022. And with the money printer still going, although at a slightly slower speed, there is a good likelihood that inflation will be a big thing in 2022, and it may not look pretty as a result. And to a degree, this point kind of goes against the previous one, because the stocks that will get hit hardest by ongoing inflation fears are growth stocks with valuations that are heavily based on profits far in the future. But we do have a relatively unusual situation where a large amount of this fear has already been baked in because of the discounts. Many of these stocks are already 60% down, and nobody knows how much further they can realistically fall. But if the valuations do fall a lot further, which they may well do, then tip number 1 just gets even better, because those growth stocks will be selling at such incredible prices, the returns in future years could be exceptionally good. Now we are talking about these growth stocks, and while we're on the topic, tip number 3 is to only play transformative industries and companies. I know that sounds kind of obvious, but let me explain. In a time when technology is changing rapidly, the halo effect of transformational companies and industries often lights up a whole lot of other sectors and other companies as well. So people get very excited about companies that are offering sometimes very commoditized products and services or have relatively limited growth potential. People will invest in a company based on its sector, irrespective of whether the company itself is actually the driver of that sector's potential or is representative of that sector's potential. Not every car company is Tesla. Not every data company is Google. And if you're investing in the next something, you better have a really good basis for making that call, because more often than not, in fact almost every time, the next Tesla or the next Google doesn't quite fit the moniker and ends up on the scrap heap of history. My next tip seems obvious again, but given what 2022 is shaping up to be, it might not be as obvious as it seems. Don't throw everything you know about investing out of the window and start trying to time the market, because it is very easy to think that this time it's different. This time you know that inflation is going to go up, you know that rates are going to go up, and you know that the market will panic and wobble, and you might as well wait for that to happen, because then you can invest at super cheap prices in your favorite stocks. When you're anticipating some of these things happening, it can be really hard to be rational and to realize that even though you think you know what's going to happen, you are still just trying to time the market. Because if the last 2 years have taught us anything, is that we have no idea which direction things will take and when they will take that direction. Anything can happen to completely throw our forecast out of the window one way or another. Maybe it'll go up, maybe it'll go down relative to what you're expecting. And if you're sitting there trying to time it and be smart, it can backfire really hard. And more often than not, it will. Now, sure, you might do it. You might go and time it and it might pay off. You know, like playing one hand of blackjack. But unfortunately, on average over time, the odds are stacked against you. And deep down, you know that timing the market is a bad idea. And the link to this is my top tip to avoid playing games, because over the last few years, the lines around what investing is and what it entails have become really blurred. Now we talk about investing in the same vein as crypto and NFTs. Leverage investing has become mainstream. Hundreds of thousands of people on Reddit are taking on the big guns with short squeezes. And here's the thing. You might do some of these. You might play some of these games and you might even win. And then you'll come back and post a smug comment saying that you made 1 zillion% return on the hottest JPEG, or your 10-to-1 leveraged S&P 500 portfolio is up 500% in 1 year. Congratulations. But there is going to be a whole lot more people that won't win in a slightly different version of the same game and won't post a comment highlighting exactly how much they've lost. I have a video that explains why I am not a fan of these latest investing trends from 2021. I'm going to put a link up to it in the description over here and in the description below as well for anyone who wants to watch it in more detail. But let's move on to the next tip. And my next tip is to prepare to take short-term pain for long-term gain in 2022. When we look back at some of the most successful investors in history, we praise them for getting an average rate of return of 20% or maybe even 30% over the course of many years. But even those investors had years when they lost money or stayed flat. Nobody avoids down years. The best investors don't sell just before the drop and then buy back at the bottom. They are the best because they have a robust long-term strategy that navigates and manages those risks. Because of the uncertainties next year, there is every chance that the stock market will trade sideways or even lose over the course of the year. Because that's what the stock market does, and it does it a lot. Something investors who've only joined this whole investing sphere in the last 2 or 3 years haven't yet actually seen. And it might seem like your strategy is not working when your positions are red for days, for weeks, for months, and going into years, because it progressively gets harder and harder to stay the course. But that is why investing is not easy. It takes a huge amount of patience and conviction in the fundamentals. And if your analysis is robust, if the fundamentals are solid, then you can get paid off the following year or the year after that. And when you do, that payoff can be substantial. So be patient, even as the media, social media, everybody you know, people at work, people in your family are panicking. It is far easier said than done. My next tip for what is likely to be a relatively volatile year is to shop heavily in the discount aisle. I often mention this strategy because it is highly effective. And in 2022, it might even be more potent than usual. With inflation, interest rates, general macroeconomics, Omicron, and the rest of it, we're probably going to see a fair few ups and downs through the year for different reasons. And that means that at different points in the year, different kinds of stocks are likely to be on sale for whatever reason. Growth stocks are currently full of discount stickers right now. But we might see a sale on the big guns too at some point later in the year, or we could have even a whole sector-wide sale, like, the banks were being sold in 2008. And if you're investing continuously through the year, and you have a number of companies that you want to invest in because you've done your homework in advance, it's pretty likely that some of those companies will be on sale at some point. It'll probably be different companies at different points in the year. So you might be buying one thing in January and then a completely different thing in June. But that's the beauty of it. You get to invest across the board into different companies that you're interested in, just at different points depending on what's on sale. Not because something has fundamentally changed about those companies, but because the stock market has decided to give you a different coupon code at a different point in time. Now, having said that, one thing that generally applies in almost every year, but is perhaps a little bit more pertinent in 2022 than average, is staying on your toes for a potential market crash. Times of instability and volatility can be a stimulator and a precursor for a crash. And of course, it is impossible to know exactly when the next crash could come. We've only had a crash relatively recently in March 2020, but that one was very short-lived, so who knows? However, one really important thing as an investor is to know what you're going to do if the crash arrives before it arrives. And I mean literally, what will your actions be if and when the stock market goes and plunges 50% in a few days? Because that day will eventually come. And sometimes you only have a narrow window of opportunity before a big bounce back. Sometimes you don't have time to think, or there's other things in your mind, like a global economic meltdown. I like to think of this one as being like a hardcore prepper. Have your bunker ready and have it fully stuffed with everything that you need. Have the think in advance as to what it is that you need to prepare. And when the moment happens, when the disaster strikes, know exactly what you need to do. Which things you need to quickly pack and bring into that bunker. Which things do you need to turn on? Which things do you need to turn off? What are the very first few things you have to do once you're in that bunker? The same kind of thinking goes here. Are there ways that you can or want to raise cash that you wouldn't normally do, but would if some of your stocks were selling at a 95% discount? How exactly would you do it? Are there things that you need to do with your property or debts? You need a plan before it happens so that when it does happen, you just go and execute instead of panicking and thinking of what to do. And now that I've just mentioned debt, another really important strategy for next year is to address variable rate debt. This is really important because although this is not part of investing per se, this will impact your financial situation a lot, and it can really affect how much money you can invest. In many countries, including the UK, things like mortgages, large forms of debt, are almost always on variable rates. Sometimes there is a temporary short-term fixed rate, but if the economy tanks, renewing your fixed rate could be pretty hard, and you might find yourself paying whatever the going rate is instead. And if the base rate is going up fast, say inflation is rising, then suddenly you might find that your mortgage rate goes up from costing 1.3% per year to maybe 10% or more. And that could literally double or triple your total mortgage payment. And that might become a bit of a problem. Same goes for credit card debt, where interest rates are tied to the base rate because some are and some are not. Flexible loans or any other form of debt where the rates are flexible and can be jacked up the moment that the base rate or the federal rate increases. If you can, switch flexible rate debt to fixed rate debt if you want certainty in your cash flow and to know that the amounts per month are not going to go up for no reason. And have a think before you get there what you might do if the situation does suddenly worsen. Do you sell your stocks to cover debts if inflation and interest rates are going to double digits? Can you consolidate or clear the debt in any other way? And how susceptible are those ways to a sudden economic worsening scenario? And my last tip is to remember that if you need to sell your stocks, sell your stocks. If life dictates that you need cash, sell the stocks. If you lose your job and you need money for your family, sell your stocks. If you are in a bad position with debt, sell your stocks. If life punches you in the face and you need cash and you don't, have it, you need to pay for a replacement car, you need to pay some medical bills, pay some unexpected taxes, whatever, sell your stocks. We have this weird culture where selling stocks is seen as a really bad thing. People think it's somehow a negative to sell your stocks, even if you really need the money. It's like taking a loss. Your portfolio size drops. People take it personally. But ask yourself the question, why have you been investing all of this time? Why have you been putting away money every month into the safety net if you're not going to use it when you're in free fall? Sometimes we don't even know what we do want the money for in our portfolio, but we won't use it. One day in the future, you're going to want to use it for something. You're not quite sure what, but something. And you don't want to jeopardize that something. But you know what? Sometimes that something is now. And in a year when we might see economic difficulties, maybe quite a bit of change, you might need that money. There is no shame in selling your stocks. That's what your portfolio is there for. Even if your portfolio has recently taken a beating, it is still money that is sitting there that can help you out. If you liked this video, please go and smash the like button for the YouTube algorithm. Thank you so much for watching. I really, really appreciate it. And as always, I'll see you guys later.